So once they close the deal, they'll get a chunk of equity, usually about a third of it. As they hit certain milestones, they'll earn additional equity. And then when they sell the business and generate a meaningful return back to investors, they'll get an additional chunk of equity in the business, that remaining one third. And usually these investors are targeting IRRs, internal rates of return on their investment, in the 20 to 30, maybe upwards of 40%. So if you feel confident that you can go in, buy a business, help it grow, and then sell it and generate a 20 to 30 to 40% return, then that can be a really great investment for you, where you end up with 25% of a really great business without having to put up any of your own capital and getting paid all along the way, just like a private equity investor would, frankly. Because you get paid to find the deal. Once you find it, you get paid to operate the deal. And once it exits, you take out a big chunk of equity right alongside the investors. The other piece to keep in mind too is a lot of these businesses are funded with debt. So when the searcher identifies the company, they're going to use dollars from their investors as equity, but then they'll also typically borrow money from banks as well to consummate the transaction. So just like a private equity fund, they also get some additional benefit from the leverage that they're putting on the business. This also means, though, that a lot of these searchers are going to be looking for businesses that are generating positive cash flow versus ones that are more focused on growth, let's say. All right, so what does all this mean for you? Well, I think if I were you and I wanted to get into the search fund space and become a searcher, first I would figure out, like, what's my unique angle?